1 in every 20 homes listed in Brampton right now is a forced sale. The homeowner fell behind on payments. The bank stepped in, and now the property is being sold, whether the owner wants it or not. And Brampton isn't alone. Mortgage delinquencies across Ontario have more than doubled since 2022. Equifax has flagged 5 cities as the primary drivers of the national surge in missed payments. And 1.3 million mortgages across Canada are about to renew, many of them locked in at pandemic-era rates that no longer exist. This is the story of what happens when prices fall, rates rise, and the math stops working. Here are 10 cities where homeowners are falling behind. Number 10, Barrie. Barrie's delinquency rate more than doubled between 2022 and the end of 2025. During the pandemic, Barrie attracted buyers from Toronto, looking for detached homes under $1 million. Prices surged, but Barrie's local economy couldn't sustain those valuations. When rates climbed and the market corrected, the people who stretched to buy at the top found themselves with mortgages worth more than their homes. What makes Barrie's situation worse is the commuter dependence. If the Toronto job market softens, and it has, Barrie feels it immediately. There's no local economic cushion to absorb the hit. Number 9, Windsor. Windsor's mortgage stress is tied directly to manufacturing. 12% of the local workforce is in manufacturing, well above the national average of 8%. And with US tariff threats and trade uncertainty, job losses in this sector hit Windsor harder than most cities. When paychecks shrink or disappear, mortgage payments don't adjust. Windsor hasn't made the Equifax top 5 for delinquencies. But the same forces driving defaults in Brampton, high mortgages, job losses, rate renewals, are all present here. It's a city to watch very closely over the next 12 months. Watford on Taster. Number 8, London. London's delinquency rate has been climbing steadily. The city didn't spike as hard as the GTA during the pandemic, but it still saw meaningful price increases that left some buyers exposed when rates rose. The average home price has dropped about 2.5% year over year. That's modest compared to Brampton or Hamilton. But for homeowners who bought near the peak, with 5% down or less, even a small decline can erase their equity entirely. And once equity disappears, refinancing options disappear with it. That's when missed payments start. Number 7, Kitchener. Number 7, Kitchener. Kitchener is part of the corridor that includes Waterloo and Cambridge, and delinquency rates here have more than doubled since 2022. The tech sector, which powered this region's boom, has been cutting back. Layoffs, hiring freezes, and slower growth have taken the fuel out of the local housing market. Prices are down 5% year over year, and CMHC has specifically flagged this region as one where housing starts will keep declining. For homeowners who bought expecting the tech boom to keep pushing values higher, the bet hasn't paid off. Number 6, Hamilton. Hamilton's average home price dropped over 8% year over year, but here's the number that matters more. During the pandemic, the typical home in Hamilton went from around $500,000 to over $900,000. A lot of those buyers used variable rate mortgages or locked in at historically low fixed rates that are now coming up for renewal. The payment shock at renewal is severe. A homeowner who locked in at 1.9%, renewing at 4.2% on an $800,000 mortgage, could see their monthly payment jump by over $1,000. That's the gap that creates delinquencies. Number 5, Vancouver. Vancouver's delinquency story is quieter, but still serious. BC's delinquency rate rose roughly 9% year over year, and Vancouver specifically has been flagged by CMHC as a market where arrears will keep rising through 2026. The issue here isn't just rates, it's the sheer size of the mortgages. A detached home in Vancouver averages over $1.8 million. Even a condo averages over $700,000. At those price points, even a small rate increase translates into hundreds of dollars more per month. Near-prime borrowers in Vancouver, people with good credit, are seeing delinquency rates nearly triple the national average. This isn't subprime borrowers in trouble. It's people with good jobs and good credit who simply bought too much house. Number 4. Oshawa. Beauty 102D. Oshawa is one of the 5 cities Equifax flagged as a primary driver of Canada's delinquency surge. Durham region, which includes Oshawa, Ajax, Whitby and Pickering, has one of the strongest inventories of power of sale properties in the entire GTA. Oshawa attracted pandemic buyers looking for affordability compared to downtown Toronto. Prices climbed, but the local economy, heavily tied to auto manufacturing, has been under pressure from tariffs and EV transition uncertainty. The combination of falling home values and rising mortgage costs is pushing more homeowners past the breaking point. Number 3. Markham. Markham is another city on Equifax's top 5 list. Detached homes here average between $1.5 and $1.6 million. Condos exceed $600,000. The stakes in a power of sale are enormous. A Markham home that could sell for $1.5 million through a proper listing might go for $1.3 million or less in a forced sale. That's $200,000 in equity that the homeowner loses simply because of how the property was sold. Near-prime borrowers in Markham are part of a cluster, along with Toronto, Brampton, Oshawa and Vancouver, where delinquency rates hit 0.64%. That's almost 3 times the national average. Toronto's mortgage delinquencies have more than quadrupled since 2022. The rate jumped from 0.15% in mid-2024 to 0.24% by mid-2025, a 60% year-over-year surge, and the highest level since 2012. CMHC has specifically warned that delinquency pressures in the GTA are expected to remain elevated throughout 2026. The condo market is the epicenter. Investors bought roughly 3 out of 4 pre-construction units. Many of those units have now closed, and the carrying costs exceed the rental income. When an investor can't cover the mortgage from rent and can't sell without taking a loss, the missed payments start. Toronto's total mortgage debt is staggering, and the renewal wave hasn't even peaked yet. 1 million mortgages are set to renew in 2026 alone. And number 1, Brampton. Brampton now has the highest mortgage delinquency rate of any major city in Canada. 0.6% of all mortgages are delinquent. That's more than double the national average of 0.26. In 2019, Brampton's delinquency rate was 0.06%. It has increased tenfold in 6 years. The typical home here nearly doubled, from $638,000 in 2019 to $1.24 million in early 2022. Then it crashed 30% to $855,000. Homeowners who bought at the peak are underwater. They can't refinance because their home is worth less than the mortgage. They can't sell without taking a massive loss, and their payments are resetting higher at renewal. 1 in every 20 homes currently listed in Brampton is a power of sale properties in the entire GTA. That means more people depending on a single mortgage payment. When that payment breaks, entire families are affected. Manufacturing accounts for 12% of local jobs. Tariffs and trade uncertainty are squeezing that sector. And mortgage rates have climbed to 4.19% on a 5-year fixed, nearly double what they were in 2020 and 2021. Brampton is where every pressure point in Canadian housing lands at the same time. Higher rates, falling prices, job losses, large mortgages, large families, no equity. It is the most financially stressed housing market in the country right now. So here's the bigger picture. 60% of outstanding mortgages in Canada will renew between 2025 and 2026. Many of those borrowers locked in at rates around 2.3%. They're renewing at nearly 4% or higher. 80% of economists now predict no rate cuts for the rest of 2026. The pressure isn't going away, it's building. If you bought during the pandemic in any of these cities, now is the time to talk to a mortgage professional. Not after you miss a payment. Before. Are you in one of these cities? Are you feeling the squeeze at renewal? Drop your story in the comments. I read every one.